So welcome. My name is Ron Lake from Lake Partners. I'll be today's moderator for the session of the Greenwich Roundtable. The topic being U.S. small cap stocks, strategy and timing. And before we do begin, let's hand it over to Steve McMenamin from Jefferies. Jefferies, of course, is the sponsor of the Greenwich Roundtable.
Thanks everyone again for coming. I'd like to welcome two new members of the roundtable, Gary Wynn and Francois Devissier. Welcome. If we can, I'd like to turn it over to Hollister Sturgis for a few seconds. Hollister?
Thank you. Well, I want to welcome all of you to the Bruce Museum. I'm the Executive Director. And we have exhibitions and programs around the year in environmental science and arts. Our exhibitions have a global reach. This past year we've shown we've had exhibitions on Islam, China, Japan, and we've got one coming on Africa. We also have a lot of family exhibitions, such as sailing. We're doing one on the thoroughbred in spring, and maybe our most successful exhibition a year ago was on dinosaurs, sort of emerging of paleontologist discoveries with the visual representation of dinosaurs by artists. Interesting kind of collaboration. Jurassic Park Bruce, right. Our sponsor today, Jefferies, and our presenters have been particular leaders in getting involved in the Bruce and supporting the Bruce. I wanted to take this occasion to thank them. Steve McMenamin and Jefferies, they have sponsored an exhibition on fashion and photography. They've had two events here, one on single malt Scotch tasting, and another cleaning the Everest. This is exactly strange. Our presenter, Mario Gavelli, has been a consistent supporter of the Bruce. He supports our annual fundraiser, the Renaissance Ball, held each June. He's had a table, I think last year he took 2 tables, and that is the principal way we raise money to fund our programming. Chuck Boyce is really Mr. Bruce. Chuck was the principal contributor who launched the campaign that built this building. He's been chairman of our board for 4 years, and I'm his honorary chairman. And he's used his considerable powers of persuasion to not only help raise money. That painting over in the far corner, the Kyle Hassan Mill Pond scene, came through Chuck's ability to persuade a local Greenwich collector to give it to us. So there's a lot of opportunity, I think, for all of you to get involved, support the Bruce, opportunities for your families, your clients, and for your employees, and we'd love to have you get involved. Thanks.
Thank you, Hollister. Wow. Thank you.
And just to round out the introductions, our other panelist is Irene Hoover, who started her own firm earlier this year. And she's formerly the director of research at Greenwich Roundtable for 7-8 years. And that firm had grown to $5 billion in total. So we're very happy to have Irene here. She's come from California to us. So thank you. Again, our topic is U.S. small cap stocks. I think there's some perception among some investors that somehow investing in small cap stocks is something akin to investing in the lottery, trying to find that one great big win that will become not a small cap stock or a mega cap stock. There was a word in the journal yesterday defining the lottery as a game played by people who don't understand math. I think our panelists are people who do understand the math, the numbers, the concepts inside and out, so we're very pleased to have this group with us to talk about this topic. Mario?
Good morning. I'm delighted to be here. Sturgis, we also sponsored our firm the dinosaur display, and we had the Brontosaurus outside in front, and I deliberately said to keep it anonymous that we were the sponsor because I could see a big sign on it saying Gavelli. Thinking back, our definition, we have a firm that has lots of moving parts. We have a big cap growth, international growth. I run the value, but I also am involved actively, intellectually, and diagnostically and intensely in the small cap. We break it down into 2 parts. Like we have the regular small cap fund that we have, which is kind of migrated up in size to $1 billion and under. and we just launched the Mighty Mites Fund, which one of my kids was playing football, and the team was called League, Pee Wee League, Pee-wee's Mighty Mites, and midgets, so I took the Mighty Mites name. Very clever, spent a lot of money to get that name. What we try to do is, in the Mighty Mites Fund, which we launched on May 1st, which was a terrific time because that's when everybody was throwing stocks, and we like to find bargains. When Chuck talks about the old days in the 70s, I go back to the 30s. Chuck is much younger than I am. When you found companies that were not disclosing information, that's the best of all worlds. They're buried in the pink sheets. You're buying cash at a big discount, what we call it nets. And from there, with disclosure. But the beauty of Wall Street is that most sell-side analysts are paid based on whether they get on the II list or whether they do corporate finance business. So they all want to follow the same big cap stocks, and they all have, march to a new drummer nowadays. And that drummer is whose bread I eat, his song I sing. And the corporate finance departments of Wall Street drive what's going on. And we can get into that. So this has left a major structural opportunity for people like Chuck and Irene and our own analysts who just are paid to find ideas to make money. We do not try to buy a company. Yes. We look for the next Microsoft if we're growth-oriented, or we look for the next Berkshire Hathaway if we're value-oriented, and we're finding. The question is, some of these companies are run by entrepreneurs who, like in the movie Waterboy, they run for their own goalpost at times. We look for companies, and we will buy 100%. We're buying a business. At the moment, we own 49.8% of a company called Hudson General. No analyst has called on the company for forever. It's located in Great Neck, New York, so it's a cheap cab ride for those that don't know how to drive. And the company was selling below cash values, and finally convinced the management to go private. So they put a bid on the table at 57 and they asked me, obviously, would you support it? I said, absolutely not. But I'm delighted that you put in a free market process. So we try to, in the value side of the house, get in front of takeovers. Our dollar price is not important. Chuck and I both own Farmer Brothers, which I guess, Chuck, is what, $240 a share? And I own something called Case Pomeroy, which is $10,000, $12,000 a share. But one of my favorites sells for 25 cents a share. It was a spin-off from a company called Versar. At 4.4 million shares at 25 cents, the market value is $1.1 million. They have a $9 million mortgage, and it's on 2 real estate buildings located in Washington, D.C. The rentals rates have gone up. The value of the underlying property today, even with lending slowing down, is probably in the vicinity of $20 million. So the stock's worth 10 times what it's selling for. And the management has to be watched. That's the one problem of small cap stocks. I mean, I'm buying a company called Carlyle today, and I'm absolutely convinced that people that are running it are going to try to steal it from the shareholders. Stock's $1, 7 million shares, $7.7 million. So it becomes, I want to own the entire company for my clients, and our clients will own it. So far, I've stopped with 49.8% on Hudson General. And the reason for that is that we're buying a business that we like, and we can get it at a 2 multiple of EBITDA or 1.3 times. I can pick up a phone call, make 5 phone calls, and sell most of the companies in my portfolio at a substantial premium. For example, yesterday you saw Perlman sold to Seta. They don't know how to pronounce Gabelli, so I can't do the French as well. They sold Consolidated Cigar at $17.75 a share. Meanwhile, if you run a deadly parallel between Consolidated Cigar and General Cigar, and I happen to think Cohiba is a much better brand than Monte Cristo, and the Cohiba brand is controlled by General Cigar, and I don't care what you think. If you want to light up one of your Cohibas, I'll put you in jail. But essentially, General Cigar is selling at $10. The Coleman family has this 30 million shares, $300 million market value. The company's worth $30 a share. So what we do is go out and find these companies that no one else likes. Now, I don't know how many of you know Aqua. Aqua has sold 12 million records last year. Okay? Andrea Bocelli, what is it, Bocelli? 10 million albums. There are areas that we just love, and we look for structural change. The United States just passed a rule that says if you own copyright, they're going to protect it for you for another 20 years. So if you have copyright in the form of publishing titles, you have just extended your franchise life. There are little companies out there in the publishing, music publishing, that are going to benefit from that, plus the internet. And we can find these because nobody's looking for them. So we look for structural change. We look for catalysts to find ideas. The question is, what kind of return? We're getting paid for the lack of liquidity in our stocks by the above-average return expectations that we have on a long-term basis. So we like this area. We think our analysts are motivated to find ideas, and so it's kind of fun. So on that note, I'll stop.
It's a great pleasure to be here between both us gentlemen.
Wait.
Which one is the gentleman, not Chuck?
I don't know whether to say this or not, but those of us who've been invested in small caps this year reminds, there's a country and western song that, I think it's country and western, I don't know, that reminds me of this year, and it's called Sometimes You're the Windshield, Sometimes You're the Bug. And this year we felt a little bit like we were the bugs, but I think right now we're back in control of the driver's seat in the small cap world. And I agree with Chuck that we're in probably a good cycle for small caps. But what I wanted to do just for a couple minutes was talk about the small cap, the definition of small caps, just briefly how I and our company approaches getting good stocks into a portfolio in the small cap area, then the outlook, and then a couple of industries and groups that we like. But I agree there's a cutoff point at about the $200 million where the micro cap becomes a small cap, and then with the increasing size of the marketplace, it does go up to $1.5 billion. But at that level, you begin to get professional management, you begin to get broader products, broader distribution, and the company takes on a different character than it had, and then it becomes a more professional company. What we, just to give you the context of where we are coming from, what we're trying to do, and what I think you need to do in the small cap universe is not worry about the fact that it's a smaller company versus a larger company, but apply the same investment criteria that you would to a larger company. And what we're really doing is trying to find really good businesses, profitable, cash generating, where there's some kind of valuation disparity at a good value. And again, I don't believe in the distinction between growth stocks and value stocks. Our portfolios would hold both. Sometimes you can buy a stock at 4 to 5 times pre-tax cash flow or a discount to its assets. Another time you want to find it where it's really selling at a low PE to its growth rate, so that you can get both the appreciation from the multiple expansion as well as the growth of the company. And then it's always important to have a catalyst, whether it's a real value stock or a undervalued growth stock. You want to have some kind of a catalyst. And when we quality business, you want to have a niche. In the small cap universe, you're going to be looking for niche companies, dominant, competitive advantage, and it's a good, rather than, and you don't want to buy tertiary suppliers to large companies. Sort of a special situations approach. And then it's very important to have well-financed companies, especially in the small cap arena, making sure that they're well capitalized to realize their growth plans. I think that's at this time when the spreads have widened so much in the market, and where it may be more difficult for the smaller companies to raise capital, you have to have a really strong and strongly capitalized company. And then I don't want to buy any stock that doesn't have a catalyst for growth. And what we try to do is find a thematic. And one of our themes right now is the infrastructure as well. And one of our favorite stocks in that area is Granite Construction. I'm from California. It's a Watsonville-based large national contractor. It's done well this year, but I think it'll continue to do so. And then you can also find a catalyst, an industry catalyst, or a direct company catalyst for growth. And that can be in the small cap arena, in addition to new management and new products, distribution, and all of the regular things that go on. It can be a recapitalization, where you have a smaller company that is either being spun out from a larger one or going public, and you now have managements which are maybe had been managing for debt pay down. They can manage for growth, and they have stock options. It's a rare opportunity. The small caps, and then I talked about the value price, but it's always very important to manage the risk in the small cap universe. And the risks really, one of the main risks, we try to manage the market risk, the liquidity risk, the financial risk. I've talked about cash generation and a strong balance sheet. But then, and also the business risk. But the liquidity risk I want to mention, because in the small cap it's been very volatile, and we try to avoid getting into extremely illiquid positions after the stock has moved up, where you're going to be, where institutions have large positions, 5 and 10% positions, and the average daily trading volume is 20 or 40,000 shares a day. That is enough to get in very, very early. And then on the business risk, I think you can look for things where you don't have to have large ticket items coming in at the end of the quarter, where you have lots of diversification in the business product line. So that's the approach and where I would be coming from. The outlook for the small caps, I believe that after 1987. Everyone always said, well, was worried about the next crash. Well, we've had the crash. And we've had the crash in small cap stocks, I think, down 40% in about 3 months was unprecedented. And I think volatility will continue, but volatility is a great, it's great in some ways, as long as it's not just that one-way down, because you can find, it gives you opportunity to buy stocks that are extremely cheap. And just one example of how, and it's going to continue to happen on a rotating basis, but St. John's Knit, I'm wearing one now, my uniform, and this summer they disappointed, I don't know, the stock got so cheap it was selling at about $250 million in the marketplace, and it was generating $80 million in pre-tax cash flow. So sure enough, the management has just bought back the stuff in the stock. It was just too cheap on a cash-generating basis. And I think if, in fact, the small-cap market doesn't move up, what we're going to see is the values unlocked by this type of buying in the shares, either from the management or strategic buyers. In our portfolio the last month, we've had 4 buyouts. If it's a cash-generating company. The polarization of the market, which we've had, probably will narrow and come in. We'll get the small cap, I was thinking of the NASDAQ 100 rather than the S&P, but the NASDAQ 100 is up 60%. And the Russell is down 9% or 8%, whatever. So there will be, I think, a change. We have opportunity. And then if you're just an investor trying to find good cash-generating companies, the place to look for better values now is in the mid and smaller caps. They just simply are better priced at this point. And then they also have domestic drivers to a greater extent, which is good. They're internally driven rather than driven by big macro forces. And so it's a time, I think, and then merger activity and acquisition activity, I think, will take place in that market. And then we like, as I said, the infrastructure. I think in the technology area, we don't invest too much in technology. We like longer product cycles than you have. But the analog semiconductors, in the software area, we have like Autodesk. It was way down because of a product cycle. And now the product cycle is coming on and the stock has come back. In the oil and oil service area, the service companies are very, very cheap. I'm not sure they're going to be strong in the near term, but if you look out 9 to 12 months, in the oil area, you have to think, would you rather be selling your oil company now, or would you rather be buying someone's oil company now? the buyer, you'd rather be a buyer, so you need a well-financed one, and just wait and hold. Education and training, these stocks are under scrutiny now, and they're probably get some opportunities as they come in, just like we recently did in CBT. And so I think it's a buyer's market in the small cap world, and it's a special situations market, and it's an exciting time to be working in that area.
And Buck, I'll turn it over to you to start us off.
Great, thank you very much. The small cap world is one of these sort of great myth things that everyone has their own personal opinion, and the reality is substantially different. The small cap world is no longer small. That's sort of the first observation. It's no longer inefficient, and it's no longer under-owned, and it hasn't been that way for some time. In the old days, sort of 70s, early 80s, small cap was certainly the zone of the undiscovered stocks, inefficiency. This was before the consultants and pension plans took over. Before there were indexes, every consultant now has a small cap index. And all of this has created a tremendous, it's a set asset category. And in a sense, it has dramatically changed the characteristics of the small cap world permanently. You can no longer say that small caps will automatically outperform large caps over a long period of time. I think you just have to say that they're different and they represent a great area of opportunity. But you can no longer kind of statistically prove that this thing is bound to perform better. In our own view, as a firm, we have taken the view the small cap world really has grown up so much. It's really two worlds. There's a microcap world at the bottom, which really is the old small cap world. It is the DFA 9-10 world, the last two deciles of the capitalization range. It is the area where there does not exist indexes. There's not really any consultant interest in the microcap world. This is the area that has the most number of stocks, probably 7, 8, 9, 10,000 companies. Then there's the rest of the small cap, sort of the standard small cap. That might be $250 million to $1.5 billion. Morningstar recently has sort of changed the definition of small cap. That no longer is $1 billion and under. It is a floating lower end capitalization as a percentage of the capitalization, which is probably the right way to do it. But it really means the weighted average for a typical small cap manager now is probably up close to $1 billion, maybe even over $1 billion. And the characteristics of that end of the small cap world are much different. These stocks trade much closer to large cap stocks that might trade 50, 100,000 shares a day. They're really very efficient stocks. Wonderful things, lots of opportunity, lots of growth, but they're really different than they used to be. I think this is a reality that's going to be around for a long time to come. The other thing that I think confuses everybody, or that we have a particular point of view, is this whole thing between value and growth. It's really kind of a dumb way to set up the world. To me, the idea is to do very well in a capitalization range with minimum risk, maximum reward. And it has nothing to do with whether you're buying low price-to-book stocks or growth stocks. There are times when growth stocks are wonderfully attractive. This might be one of those times. There are times when asset stocks are very attractive. So I think this whole kind of rigorous trying to put people in the style boxes is actually a big mistake. And I think consultants make an error in kind of trying to push you into a very particular style, when in fact we're all in the same business. We're kind of trying to manage risk within a capitalization zone. So that's what we're all about. We have a very strong view that we're in a different market cycle now. That market cycle started October 8th. It has come after a substantial period of underperformance. That underperformance period was started in May of '96 and went right through October of '98. And the degree of underperformance is much greater than you think. We all kind of know it was pretty lousy, but the Russell was down 12% and the S&P was up 50%. we had 6,000 basis points discrepancy. And in this new cycle, we will not have the same characteristics. We're going to have a much more democratic cycle. I think small caps will do very well in the beginning, in the first 6 months or a year, and probably do very well throughout the cycle. We are in a much lower return cycle for sure. We're not going to have an 8-year cycle, absolutely. Interest rates are too low to give us the kind of backdrop for a large cycle or a large return period. So I think we're going to be in a low return period where small caps are going to do extremely well. We have points of view about all sorts of small stocks. Two favorite industries of ours right now is the peace dividend that never took place, the whole infrastructure activity. There was a major bill passed in the last year that will funnel billions of dollars, much delayed, much deferred, into infrastructure. Our two favorites would be Florida Rock, a rock company in Florida that's in the process of building a cement plant that nobody wanted them to have. And Morrison Knudsen, a very standard, actually wonderful old line firm that went through bankruptcy. And Dennis Washington took it over about a year and a half ago and is doing a spectacular job. And we'll have a wonderfully good effect in the next 2 or 3 years as these contracts wind through the system. Thank you very much.
We open up to any questions or comments from the group.
Let me ask Chuck a question. Chuck, what are you buying?
Another group which I mentioned, or maybe I don't remember what I mentioned.
Do it now.
The freight forwarding group, I think, is a very attractive area. It's been hit by the Asia crisis. It's always had tremendous returns on capital. These are essentially non-asset ownership kinds of service companies. There's only 4 or 5 major companies, and basically we like them all. We like Circle a lot. Probably our favorite. We like this Pitts and Backs. It's a real turnaround. So those would be a couple.
At least 2 or 3 of you are very positive about small caps. It may have been all 3. I think they're quite very well.
I basically every day come into work looking for new ideas. I don't look at it generically, Gary, in terms of what I'm buying. I'm size agnostic. I mean, if I can find a company where the CEO tells me that she's going to sell the business, I'll buy it at a price. I think it's just a great place to make a lot of money because it's become inefficient because the momentum players, the indexers, they're not there. All those.
The 2 others that are generally optimistic about it. Were you also optimistic a year ago, 2 years ago, and 3 years ago? And if so, what went wrong? And if not,
Well, in our case, we have not been we're sort of an absolute buyer. We're really looking at the individual specific risk return and really did not see the wonderful return possibilities 2 or 3 years ago. It all shifted, though, from that first peak in the small cap marketplace, which was in May of '96. It was an IPO peak, the technology moment. And then there was a tremendous crash after that in technology, small cap technology, small cap growth, which set up a tremendous risk-reward parameter in the last year or so. So we've been very optimistic for the last year in these kind of really crashed areas. Now, the statistical reason to be optimistic, though, is every time you've had a decline of more than 20%, there's only been a half a dozen of those since '74. You've had a minimum of 70% absolute return in the next 2 years. So you have a very strong, powerful history about how this works. It works because people give up on small caps. And they gave up this time. They were down 38% from April to October. And they're nowhere near back to their highs.
Yeah. May of '96, I was a month later than that, realizing in June 1st, really, of '96, that they were overvalued. They collapsed rapidly after that time. Then you have an opportunity to get in at the lower price. We had another overvalued market in last October. The small caps had run up tremendously, and they had a bad collapse. But the one we had this year, and I was very, I resigned my old job in October 1st of last year. I was very concerned. I was planning to start my own firm. I started it in January, and we actually, the process, I have evaluation parameters, so I can't find good stocks to buy when the market is up, and the cash built. And I was starting a new firm, and I was very cautious throughout the year, and we had a lot of cash this year, and then we were able to put it to work after the market had its downdraft. And we'll always have volatility in the market. What I'm really trying to do is find good companies that are at a cheap price in the market where they have cash that's selling, cash generation that is selling at a low multiple. If the company is generating great cash, I'm going to benefit as a shareholder. And when you get a multiple too high, and the market tells you that, you just can't find anything. And so now you can find things. And I've never seen it happier hunting ground than in the middle of October.
Yeah, that's interesting, Chuck. You put not only your intellectual prowess, but your capital on the line with small cap. And so as I read, because both of you have your own firms, terrific.
Yeah, the principal benefit of having your own firm is you're very unlikely to be fired during a bad
That's not necessarily true. You don't have to deal with your clients.
Continuing on the theme, what have been the catalysts in the case of Chuck? So there were 6 times that we saw a big spread between the large cap and the small cap. And which were the caps?
Each one was different. Each one was different one, and actually, I don't think you really can't generalize. Sometimes you had a overall market moment. Other times it was a very specific small cap peak in '83. The small caps made a peak, and large caps just did fine. And you had a tremendous crash from June of '83. I don't know, went for a year or so. That was really independent of the large cap market. It's really a little bit like this May through July, May of '96 and July of '98 period, where small caps just went down, large caps continued on. But what you really go through is a cycle of comfort and then disgorgement, and it's just ebbs and flows, and that's just in the classical way why people give up. And you had a give up period this October. There's no question about it in my mind.
Yeah, from my end, Regina, whom we know, calculated that we had 38 takeovers in the small cap area this year alone. We think while the mega deals that Deutsche Bank, Bankers Trust, Daimler Chrysler, and ExxonMobil make the headlines, there's an enormous feeding frenzy that will accentuate because the spread between the big cap and small cap. So what we like to do, whether it's growth like Celestial Tea or companies that like Hudson General that are in front of someone's lovemaking, is where we like to position ourselves. So we're kind of a matchmakers here, because if we own 20% of something, it makes it easier for someone to buy it.
Are you an activist?
So that was the answer one. I'm a lamb in lamb's clothing.
2 questions.
But don't get on our own silence.
You gave us some of your long ideas. Despite the fact that the small cap universe has been undervalued, do you have any short ideas and any thoughts on how you hedge a small cap portfolio?
Well, our strategy is primarily a long strategy, so
we do some shorting, and we don't talk about it. So there's nothing to be gained for it. We always get in trouble when we open our mouth about something that we think is doing a lousy job. But we have a few candidates, and I'll glad to talk to you afterwards.
Well, shorting is not something you want to put in a fishbowl as much as you want to go long, because particularly in small cap stocks. I love the stories. Every cycle, every mania, like you're having now, an internet, like you had cigars. I remember going down to Little Havana, Miami, My cellular phone wasn't working because there's a block out in this area because of the high floor there. I drive into this corporation that had a market value of $120 million. And I'm interviewing the guy, and he had Cigar X was the brand name. He had 10 individuals at 5 rows each rolling cigars. The market value was $120 million. It was very clear to me that this was, I don't want to say, a materially overpriced situation. The stock a year later is selling at about a dime. So you can find these. You just have to go out and do the work, and you'll make a lot of money shorting the internet, just like today Amazon is making a lot of money. I mean, the market value of Amazon is probably bigger than Russell 2000.
Which it was on last year.
What is the market value of Russell 2000? That's one of the great trivia questions.
Yeah, I don't know. But here's a trivia question. How big is the small cap marketplace in total capitalization?
Size of Amazon and eBay.
Well, it's over $1 trillion. There's plenty to do in the small cap world. No one should ever say you can't find something.
Follow on Lauren's question, and notwithstanding the fact that juxtaposition is a dumb way to look at things, but the value growth spread is at historic wide levels. Anecdotally, any explanation? What is driving that?
Value stocks being somewhat overpriced, growth stocks being very attractive. Is that what you're referring to?
The value growth spread, the fact that growth is beating value by, to look at it, 25% in 1998. The spread between growth and value.
On performance or
on
value?
performance?
On performance. Well, first place, that wasn't true until October 8th. Since October 8th, the growth stocks have done very well. They have led this. Advance. They're up maybe 40%, and the value stocks have done fine also. The attractive areas, I think, are in the growth area. You can capture 15-20% growers 4-10 times earnings all over the place. And I think it's one of the best moments for capturing high growth. If we could press a button and move our whole portfolio, which we cannot do, we could capture higher growth today than we could any time in the last 3 or 4 years.
As a general rule, do quality of management issues for the investor differ as between small cap stocks and large cap stocks? I mean, you're looking at different skill sets when you evaluate these situations, or the same skill set? Is it as important a dynamic?
Well, I look at it company by company. I'll give you an example. Earl Scheib had a terrible management. Absolutely terrible. So we waited until the management changed, and now we own 30% of the company. The stock sells at 5. There's 4.5 million shares, 22 million market value, and I used to paint cars. And if I can be of an influence or an observation, not an influence, if I can observe to the new management team that they're going to become a consolidator in a fragmented collision repair business. The answer is that the management, what happens in the company, though, is that a CFO at that company is going to make $120,000. If he was worth $800,000 in the marketplace, that company couldn't afford it. So he would leave. So you have scale. And that doesn't mean that you can't have entrepreneurs. So the entrepreneur driver in a lot of these companies is very important. Then what happens is capital gets lazy. I mean, you take Carter Wallace, Henry Hoyt.